Go ahead.
Stock market is breaking down. The breakage we saw into early this month, low on April 7th, was in fact real, a trend direction move. In fact, we broke momentum structures, not price, back in January for the S&P and in early March for the NASDAQ 100. And then we had the gusher that followed after that NASDAQ break. We dropped precisely to a level that we had predicted in MSA would be a bounce point. Not a bottom, just a point where bargain hunters would come in thinking, oh boy, a corrective pullback, I can get long. And the number was 16,500 on NASDAQ, and boy, its low was right around there. And for the S&P, it was 4,800, and it stopped at 4,830. And we've had a huge bounce that came 48 hours later. It was the April 7th, a Monday, stabilized on Tuesday, and then Wednesday shot up enormously. That's when Trump said, again, the market seems to behave by the wishes and the wands of government. A 90-day pause. Okay. And they said, oh boy. So they rallied sharply. It's now nearing the end of the month. And finally, the rally high that occurred on that day, the 9th, which has been the top of all the action all month. We've gone up to it 2-3 times and not been able to get through that price high, that rally high. We're nipping it out right now. Thank goodness. And, the reason, you get those last half a dozen candles, that looks like a daily there or something.
Yep.
But that big green candle you see there, we're finally nipping out that high after a couple efforts to do so. And so that would no doubt turn on price chart folks. Oh boy, a bottom's completed. We broke out over the ceiling.
Right.
Well, momentum is chuckling at it. Momentum says, you're broken, guy. You want to try to get off the street and get on the curb, fine. But that breakout, which I'd like to see because I want to see what happens. Meaning, once you do that, there ought to be a big party, right? Okay, everybody's, oh boy, it's bottom, that's broke out. It's when that breakout fumbles, a couple days from now, or maybe the same day you break out. That's when disappointment starts because they think, oh, I had a low and I broke out of a base, but the base wasn't valid. And so I suspect that's going to happen. We're going to take out that high if we haven't already while we're talking. And let's see what happens. We argue that no, it's a baloney rally. And if you look at it another way, since that low near 4,800 on the S&P on the 7th, you've spent 3 weeks now spinning and spinning, but really not doing much better than you did hours after that low.
Mm-hmm.
And again, we had another government from above announcement, namely, no, I'm not going to fire Powell. After the day before, he's going to fire Powell. And so the market is like a bunch of little kids, and the daddy's throwing them candy. And that's not how markets move. If you think you can buy a market because, the government says something, then, do so if you want. We think the market is fully broken and this is merely a pause, a bounce. And obviously massive disappointment's going to come in if you ever roll back over. I think when you roll back over through the low we saw early this month in the NASDAQ and the S&P, that's when people are saying, my gosh, we didn't hold on top of the 2022 highs, which is what the S&P just did at 4,800. And that's when real emotional disappointment will come into the average technician who's looking at a price chart. Okay, that's one thing to look at. The other thing to look at is the T-bond market. T-bond market had a crash event in early April as well. We thought originally that the bond market could do what it normally does in a negative stock market situation, and that is advance, go up in price, drop in yield. It did that between 2000 and 2002. Between 2007, 2009, those two bear trends, the bonds were a place to be. So was gold. So bonds and gold competed as the prime alternatives. And we saw enough technicals to justify the T-bonds rallying, perhaps, I'm talking T-bond futures now, 30-year bonds. They were trading in the mid-teens, 110, 111, 12, 13, 14, and they shot up to 122 plus. You can see that spike there. What do you have here, a daily? Okay.
Yeah. Daily on the 30-year.
Daily on the 30-year. Okay, well, there was a collapse back in, you're looking at yield here. Okay, Yeah, you can see that drop in yield, very sharp drop, and then the explosion that occurred over the next few days, meaning the drop in yields or the rise in yields and the drop in price. So inverted to what we look at. That was almost a crash event for bonds in terms of price. To change price, it was an 11-point drop in the T-bonds futures price in that matter of a couple of days. And since then, the T-bonds have done the yield has done the exact opposite of what the S&P has done, namely congest at the upper end of that event. S&P is congested at the bottom end And when this, I'd watch the T-bonds, because when you start to roll over again, meaning you start to rally this chart some more, back through those recent cluster of highs,
Right.
that's when the central bank especially is going to realize they are totally out of control in terms of managing government debt market. And that's a bigger event for them than Nvidia going down, believe, in which case they will, they'll put full throttle at that point.
Let's start here. The stock market is breaking down. That's not hyperbole. That's not a hot take. That's the read of the momentum structure. And frankly, it's been in the cards for a while. Back on April 7th, we saw a low that was significant not because of price alone, but because of what it represented. This wasn't just a pause, a hiccup. No, this was a directional trend shift. You can feel it. You can see it. Momentum told us this was coming in January for the S&P and March for the NASDAQ 100. Price caught up eventually, like it always does. When the NASDAQ finally broke, it was textbook. It didn't just trickle down. It dropped like it had been holding its breath too long. A gusher. And where did it go? Right to the level MSA had called in advance, 16,500. Not because it was a magical number on a price chart, but because that's where momentum said the reflex buyers would come in. Bargain hunters. Dip buyers. The usual suspects who don't know they're walking into a burning theater because the smoke hasn't hit the lobby yet. And they bought it. Boom. 48 hours later, we had a rally that looked massive. Oh boy, they said, we've got a bottom. Really? You bounce off a level that has been burned into the minds of every retail trader who's got a crayon and a TradingView subscription, and you think that's a bottom? That's a trapdoor with a welcome mat on it. And here we are, closing out April. We've revisited that rally high, April 9th, 3 times now. We just barely nipped it. But momentum hasn't confirmed a breakout. Momentum is standing off to the side, arms crossed, saying, "Show me something real." Now you might say, okay, but what about fundamentals? Look, forget about them. We live in a world where the market trades on perception and Fed narratives, not earnings or balance sheets. So yes, when Trump walked back his Powell comment with that, "I'm not going to fire him" clarification, the markets jumped. Of course they did. That's the kind of Pavlovian response we've come to expect. The markets move not on policy, but on the tone of a tweet, or in this case, a truth social post. But here's the thing that gets me. You look at this price action, this fake breakout attempt, and it's not a sign of strength. It's the sign of a market running on fumes and tweets. If this rally fails, and I believe it will, it's going to lead to massive disappointment, and not just among technicians, among institutions who actually believed the Fed or the Treasury or the administration was going to throw them a real lifeline. Let's pivot to bonds because they're not playing along either. I'll be the first to say it. I thought T-bonds could rally. Not because they're fundamentally sound, far from it, but because in prior bear markets, bonds and gold were the go-to safe havens. Think 2000 to 2002, 2007 to 2009, bonds did well. They were the asset that said, hey, I'm boring, but I'll keep your money alive. So what happened this time? A brief rally, a tease. T-bond futures ran from the mid-100s to 122, nice move. Then the trapdoor opened. Boom. A collapse in just a couple days that shaved 11 points off the 30-year bond futures. That's a crash. In bond world, that's a scream into the abyss. Now here's where it gets interesting. While equities and bonds are supposed to be in a tug of war, this time they're both bleeding. And gold? Oh, gold is just waiting for the next push. That drop in bonds, that's a flashing red warning sign for the central banks. And if you think Powell isn't watching, think again. He may pretend like he's playing 4D chess, but the board is on fire. If the Treasury market starts to wobble again, especially in a week where Nvidia's earnings are bad, or Tesla breaks another support level, you can bet the Fed's going to panic. Maybe not openly, maybe not in a press conference, but you'll see it in the T-bill purchases. You'll see it in the repo injections. You'll feel it in the dollar. And speaking of the dollar, what a mess. The dollar index is holding on like a drunk at closing time. Every time there's a little rally, it's sold right back down. The safe haven trade, it's rotating, not into bonds, not into the dollar, into gold. And it's about to get worse. Because when you see gold back off from 3,490, a new all-time high, and everyone starts saying it's overbought, it's a bubble. It looks like 1980, or this is 2011 all over again. What they're really saying is, I missed the move, and I hope it comes back down so I can pretend I was smart. Newsflash. This is no 1980 or 2011. This is 1977. This is the beginning of something that will outlast the memory of the people trying to trade it. You want to know what's even more bullish? Silver. Look at silver over the past few weeks. Gold gets slammed, down 3%, and silver goes up? Excuse me? That's not supposed to happen. But it did. And that tells you something big. Silver is starting to detach from the industrial metals and rejoin the monetary metals. It's not copper with a shine anymore. It's becoming money again. This is where the slingshot comes in. Gold leads, then it pauses. Silver lags, then explodes. The gold to silver ratio is still ridiculous, hanging around 90 to 1. Historically, that's a fire alarm. At minimum, we get back to 50 to 1. At max, we could see 16 to 1 again. Imagine what that does to silver from here. If gold hits $4,000 and the ratio compresses to 50, we're talking $80 silver. If we go to 30, we're talking triple digits. Now you pair that with gold miners, especially the juniors, the GDXJ names that no one wants to touch until they've tripled. And you've got asymmetric upside like we haven't seen in a generation. These miners haven't just been underperformers. They've been ignored, forgotten, actively hated. And yet their earnings are about to inflect. Just look at Newmont. Beat earnings by 42%. Year-over-year profit growth over 125%. And the stock is flat. Why? Because analysts can't model gold at $3,300. They're still using $2,100 in their spreadsheets. That'll change. And when it does, the re-rating will be violent. And here's the punchline. None of this is priced in. The institutions haven't rotated. The pension funds haven't even opened the playbook. The sovereigns have started buying gold, but they haven't started buying miners. Retail isn't in. Wall Street isn't in. And yet the setups are in. Momentum told us this was coming. Now we're watching it unfold.
Well, gold knows this. And that's why gold's done what it's done, especially for the last year or so, since March of 2024, when it came up through 2000, fourth time. And now we have a sharp pullback in gold. We understand that I don't pay too much attention to internet chatter, but a lot of analysts on the internet have been saying, gold's got to collapse. It's overdone. This looks like 1980. This looks like 2011, et cetera, et cetera. And finally, they've been saying that for a couple of weeks, by the way. Finally, it did that. We had a very sharp drop in the last 48 hours. Now we're up today. And they no doubt think that was it. We were right. And we argue, no, you're not right. It is highly unlikely a top. That's just another teeth-shattering drop. And unlike most of you go back there to go back here to 2020. 2020, yeah. Go back to 2024. Well, yeah, right there. That's when gold came up through that 2000 price level again in early 2024. And we said, okay, the sleepy zone that gold had been in since 2020, namely in a basically horizontal zone, is over. We're going up, and it surged. But look at the layered, time-consuming congestion zones and corrections that occurred over the last year. Mm-hmm. This one, the last one we had, a couple weeks ago, a month or so ago, was a very quick one, a huge red bar to the downside. Then we're jolted back up, and now another jolt to the downside. But they tend to be quicker and over with quickly. And we don't think this was the top. There's a couple reasons for that. And we think that right now we're on the cusp, partly because of the gold pullback, but silver has pushed back up relative to gold in the last couple days. If you'll notice, and this has got to be very confusing to silver folks, gold collapses in a 24, 48 hour period, and yet silver goes up each of those days. What the heck is going on? And I think what's going on is silver right now has been priced. You're going back there to May of last year, so almost a full year of, you could draw a line sideways on silver. And we've been either side of that $33 high that occurred in May of last year. So we're coming up to May of this year, so it's been 12 months. And they've been selling it, and we've had a third sell-off. And this third one really looked real to most people. You went down and blew out the prior low that had occurred late last year. So you actually broke the what you might call an uptrend for the price folks. Look what happened after that, an immediate thunderbolt back up, not just a day or two, but persisting now into 3 weeks. And now we're back pressing up, trying to get to 34, for example. And we think even touching 34 is a big tell. You ever touch 35 again, and if you're a point and figure guy, X's and O's, right. $1 and $3 down, and you've got a double top up there at 35. I say top, meaning a flat structure. You go back to 35 a third time, you're going to have a triple top breakout. Silver does not top with double tops, much less triple top.
All right, now let's go deeper. We've talked about gold, how it's broken out, how the market refuses to acknowledge what's happening. But if gold is the general, silver is the special forces unit. It's quiet, it's waiting, and when it moves, it doesn't ask for permission. We're sitting here watching silver bump up against $34 again. That number's been key for months now. And let's not forget, it's been over a year since we first hit that 33 to 34 range back in May of 2024. So what have we done since then? We've oscillated, we've churned, we've shaken out the weak hands and the newsletter guys who thought $30 was a good exit point. And now, after 3 failed breakout attempts, we're knocking again. Every time silver touches $35, it's like lightning hits a tree. The energy builds, the chart tension ratchets up, and for the technicians who follow point and figure charts, yeah, the old X's and O's, you know what's about to happen if we touch $35 again. Triple top breakout. And silver doesn't just poke through resistance when that setup happens. It detonates. Now here's the fun part. Silver's behavior over the past few weeks has been inversely correlated to gold. Gold's down sharply. Silver's up. That's not noise. That's a regime shift. That's monetary silver decoupling from industrial silver in investor psychology. People are starting to realize silver is money, not just a shiny version of copper. And there's another force behind this. For the past 2 decades, the bullion banks, 8 of them in particular, have carried the largest concentrated short position in any commodity in the world. And guess what that commodity is? That's right, silver. JP Morgan, HSBC, Citi, you name them, all carrying paper contracts and suppressing a market that has been structurally in deficit for years. Let me say that again. Structurally in deficit, demand for silver and solar, EVs, medical tech, 5G infrastructure, and yes, military applications. It's exploding. But you won't see military listed as an official demand category in the Silver Institute reports. Why? Because they don't want you to know that guided missiles, drones, satellites, and advanced surveillance equipment cannot function without silver. Silver isn't just a monetary metal, it's a strategic asset, a national security input, and the US doesn't produce enough. That's why countries like China and India are outbidding the West and paying premiums directly to miners. They're bypassing the LBMA. They're bypassing the COMEX. They're going to the source and saying, we'll pay you double if you don't sell to the West. This is what happens when suppression becomes a vulnerability. We suppress silver to protect fiat credibility and to keep the inflation narrative under control. But other nations, strategic adversaries, have weaponized that manipulation against us. They're draining the vaults, standing for delivery, and stacking real metal while our financial system plays paper games. And that brings me to the miners. Look, if there's one sector that's suffered more unjustified hate than gold miners, it's silver miners. They've been left for dead. Index funds don't own them. Wall Street analysts barely cover them. And yet their fundamentals have never looked better. Take a basket like Silge, junior silver miners, or go deeper into names like First Majestic Fortuna, MAG Silver. These are companies trading at 3 times cash flow with 0 debt and triple-digit earnings growth projections if silver breaches $35. And the market cap. Some of them are worth less than the proven metal sitting in the ground under their control. Now let's talk mechanics. You own an ounce of silver today, and it's trading at $33. If we get a gold to silver ratio collapse back to 50 to 1, still a stretched historical average, you're looking at $70 silver if gold hits $3,500. But if we get a true mean reversion, say 35 to 1, you're looking at $100 silver. And we're not even talking about 16 to 1, the ancient monetary ratio that governed global finance for 5,000 years. Now ask yourself, what happens to the silver miners when silver triples? They don't triple. They go 5x P2 Kiom. The leverage is baked in. Why? Because their cost structure is fixed. Once silver breaks out, every additional dollar over their all-in sustaining cost drops straight to the bottom line. That's the power of margin expansion. That's why mining stocks move like rocket fuel in the early stages of monetary panic, and we're just getting started. The institutional rotation hasn't even begun. Endowments, pensions, insurance companies, none of them own physical. None of them own miners. Why? Because they've been fed the line that gold doesn't yield and miners are risky. Well, guess what's risky now? Treasury bonds. You want to talk risk? Try holding a 30-year bond yielding 4.5% when inflation is 8%. The deficit is $2 trillion and rising. And the Federal Reserve is buying its own debt to keep the illusion alive. That's not fixed income, that's fixed loss. Meanwhile, gold has doubled the performance of the 10-year Treasury since the year 2000, and it's not done. You know what else gold doesn't have? Counterparty risk. You can't sanction gold, you can't freeze it, you can't bail it in. And now, it's back at the center of the monetary universe. Think I'm exaggerating? Go look at what's happening in China. They've shut down outbound shipments. They've built a multi-year stockpile. And they're buying gold every single month through the PBOC. Do they care about price? Number, they care about weight, ounces, grams, tons. Same with India, same with Turkey, same with Russia. Meanwhile, the West is still arguing about whether gold is a relic. That's fine, let them argue. While they're yelling on CNBC about Bitcoin, the rest of the world is accumulating the only asset that has survived every currency collapse in history. And it's not just the price of gold that's telling you something, it's the behavior. We're seeing record delivery requests on the COMEX, record imports into the US from London, reclassification of gold on central bank balance sheets, gold-backed digital currency pilots, Basel III compliance shifts, all of it. Gold is not reacting to inflation. Gold is anticipating a systemic reset. And silver? It's the coiled spring under the table, waiting for its moment. When that moment comes, it won't wait for retail to figure it out. It won't wait for Bloomberg to write a feature article. It won't wait for BlackRock to launch an ETF. It'll happen in a weekend. Gold will gap $300 higher. Silver will gap $5 to $10 higher. The miners will open 20% up, and you'll be trying to click buy on a stock that's halted. This is why you position before the breakout, not after. This is why momentum matters. Because price is the last thing to move. So to wrap up, where are we now? We are in a multi-decade transition where fiat credibility is unraveling. The bond market is losing control, and gold is quietly reclaiming its role as the primary monetary asset on Earth. Silver is the next shoe to drop. And the miners? They're the last most asymmetric trade left in the developed markets, so do yourself a favor. Stop watching the S&P. Stop watching Powell's press conferences. Stop pretending earnings matter in a world where the Fed is buying its own debt. Watch momentum. Watch the spreads. And above all, watch gold and silver. Because this is not a top. This is not a fade. This is the beginning of something very big. And most people still don't see it. But you do.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.